So we're going to pick up with doing some of these adjusting entries now before we can get ready. So remember, we are in December 31st. It's the last day of our fiscal year. We're getting ready to do our financial statements and close out our books. But before we can do that, we need to do some of the updates to our accounts. Now, again, this is very important that you have either the notes pages or some paper and pencil where you can go along and do these journal entries with us. This is a huge part of this chapter, and I want to make sure that you've got those written down and you're engaging in the content. So again, as always, after I've done a couple of them, I would ask you to please, pause the video, try to do it on your own, and then restart the video and listen, see the answer and listen to my explanation of it. Also, you'll notice that their learning objective 3 is broken into two different videos. So it's this is a long objective. So this is learning objective 3. I called it 3.1. Because it was the first half, and then learning objective 3.2 and 4 will be in the next video. So when we left off in chapter 2, we had just done the trial balance. And actually, that's the first of 3 trial balances that we're going to do. So that one is more specifically called the unadjusted trial balance. Remember, it's just a list of all of our accounts and what their balances are, whether it's a debit or a credit, and we've totaled them and made sure that they balance. And these numbers are what we're going to go off of. But if we're scanning through these numbers, let's just look through here a little bit. We see office supplies of $500. Well, if I remember back to chapter 2, we bought those office supplies on November 2nd, I believe. We went to Office Depot, we bought $500 worth of office supplies, we came home, we put them in our supply closet, and we've just been using those supplies over the last 2 months. We don't actually do a journal entry every time we go to the supply closet and get a ream of printer paper or a packet of Post-it notes or another pen or something, because really we're paying our accountant a lot of money and we don't want them doing a journal entry for 25 cents. That's kind of a waste of their time. But we know that there's not $500 of office supplies left. We've used some of them. So before I can do my financial statements, I'm going to need to go in and update that amount. I'm going to need to go in and see how much office supplies do I have left, how much have I used, and can I update that? If you remember the prepaid rent, we prepaid the rent on December 1st for 3 months, $3,000 for 3 months. Here it is, the end of December. Now, I don't have 3 months of prepaid rent anymore. I've used up 1 month. I've got 2 months left, but not 3 months. So this prepaid rent of $3,000 isn't actually correct anymore. Okay. Now, normally we do journal entries when some paperwork comes across our desk, but there's no paperwork coming across our desk saying, by the way, a month of prepaid rent is gone. There's no paperwork coming across our desk saying, hey, you've used some office supplies. So there are certain entries that we just have to know that we need to go in and update before we can do our financial statements. And that's what we're going to do now. So adjusting entries are always made at the end of the accounting period. They may be annually, you may make them quarterly, but they are to go in and update those accounts because there's no paperwork that's generated. They're just something that we know we need to update. Now, 2 important key characteristics about adjusting entries. Number 1, they will always involve at least 1 balance sheet account and at least 1 income statement account. You never have an adjusting entry that's 2 balance sheet accounts or 2 income statement accounts. Now remember, income statement accounts are revenue and expenses. Balance sheet accounts are the accounting equation, assets, liabilities, equity, right? So you're always going to have an asset, liability, or equity and a revenue or an expense. There's always a combination of balance sheet accounts and income statement accounts. The other thing is that adjusting entries will never, ever, 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 I want you to highlight this, underline it, star it, never involve cash. Cash always generates paperwork. That's always a normal entry. Even if it occurs on the 31st, that's not an adjusting entry. Now, there's two different types of adjusting entries. It's not important to me that you be able to say, oh, this adjusting entry is a deferral or this adjusting entry is an accrual, but there are two different types. So there's deferrals. This is something that is, it becomes a revenue or an expense after cash has been received or paid. And then accruals are when the cash is received or paid after the expense has been incurred or the revenue has been incurred. So we'll walk through again both of these. It's again not important that you be able to say, oh, this is a deferral or this is an accrual. So deferred expenses are also called prepaid expenses. These are things that we paid for them up front. We recorded them as an asset. Remember, prepaid expenses are assets. So we recorded these as an asset, like our office supplies. But now that some time has passed, we've used up these assets, and so now we need to go through and adjust that account to move those amount of office supplies that we've used out of the asset into an expense. Okay. So a good example is, let's go back to our prepaid rent example. Now, we talked about this one and we did this back in chapter 2, but just to refresh our memory, we're told on December 1st we prepaid 3 months of office rent for $3,000. So if you remember back to chapter 2 when we did this entry, we debited prepaid rent and we credited cash for $3,000. Now, this is a good time to remember aid reveille, and if you haven't written that across the top of your notes, I would encourage you to do so now. So remember, prepaid rent is an asset. Assets have a normal debit balance. Since we have more prepaid rent now than we did before, we're going to debit prepaid rent to increase it for $3,000. Remember, debits are always listed first and they're left aligned, and the debit amount goes in the first column. Then, since we spent cash, cash is an asset. Assets have a normal debit balance, but since I spent cash, I have less cash now than I did before. So I'm going to credit cash to decrease the cash account. So on the second line, I indented a little bit. Don't forget to indent. And then I listed cash, and then I put the amount in the second column. Remember, our cardinal rule of accounting is debits always have to equal credit. So we have a 3,000 debit and a 3,000 credit. So this is not the adjusting entry. This was our original entry that we made back on December 1st. Okay. So if we look at our prepaid rent T account, and I encourage you, I hope you've drawn that T account out now in your notes. You've drawn prepaid rent. It has a debit balance of $3,000. So here it is, December 31st. I'm going to draw on my hair. It's December 31st. I'm going through all of my accounts. I say, prepaid rent, does it still have a balance of $3,000? Because that was, remember, for 3 months of rent. That was going to cover me December, January, and February. But it's the end of December now. I don't have $3,000 of prepaid rent anymore. I've used up 1 month of prepaid rent. So if I were to do my balance sheet and just leave it like this and say I had $3,000 of prepaid rent, that would be overstating my assets. And the FASB and the SEC really frown on overstating your assets. That's not a good thing to do. So I need to somehow adjust this account to say that I don't have 3 months of prepaid rent. I have 2 months of prepaid rent. So instead of this account having a debit balance of $3,000, this account should have a debit balance of $2,000. Now, again, forgive me, I still don't have a touchscreen computer, but somehow I need to make this T account go from a $3,000 debit to a $2,000 debit. So how can I do that? The only way I can do that is by crediting prepaid rent for $1,000. So remember, prepaid rent's an asset. Assets have a normal debit balance. So to decrease the account, I would credit it. I would say, hey, I've used up, I'm going to decrease prepaid rent because I've used up $1,000 of it, and that will give me the correct balance of $2,000 in my books. So again, we talked about how it's $1,000 a month. So now on December 31st, I need to do the adjusting entry. So I already know that I need to credit prepaid rent. So my debit would need, and prepaid rent is an asset, so it's on the balance sheet. So my debit would then need to be to an income statement account. Remember, all adjusting entries involve a balance sheet and an income statement account. So I can either debit revenue or expense. So let's think about which one makes most sense. Well, it would have to be the expense. I didn't earn anything. I didn't do any work by renting this office, but I did incur a cost in order to generate revenue. I had to use the office in order to generate revenue. So I have an expense. Remember, one of our definitions of an expense is an asset that is used up. I used up prepaid rent, so that makes it an expense. And if you remember back from chapter 2, we said that we always debit expenses. So I'm going to debit rent expense for $1,000 and credit prepaid rent for $1,000. Remember, debits are listed first, they're left aligned. Credits are listed second, and they're indented. So now I can look at my T accounts. I see that prepaid rent correctly has a balance of $2,000, and rent expense now shows a correct balance of $3,000 once I add it to what was already in my rent expense T account. So we talked about office supplies as well. Remember, back on November 3rd, we were told that we purchased $500 of office supplies on account. Remember, we've talked about, since we are the buyer here, this on account is an account payable. If I'm purchasing something, it's accounts payable. So if you remember, we did our journal entry to record this. We debited office supplies and we credited accounts payable for $500. Now, we did some journal entries in here where we paid off the accounts payable, but that had no effect on the office supplies. But what we've done is we've stuck these office supplies in the supply closet, and then we've just used them and gotten them as we needed them. So here we're told that it's December 31st. We've gone in, we've looked at our supply closet, and we've estimated, we talked about how there's a lot of estimates, we estimated that, hey, there's about $100 of supplies left on hand. So if there was 500 to start with and there's only $100 left, then how much must we have used? Okay. We had to have used $400 worth of office supplies, right? So if I were to look at my office supplies T account, it has a balance of 500. I think it should have a balance of about 100. So somehow I need to make this account go from a 500 debit to a 100 debit. So the only way that I can do that would be with a credit over here of $400 to show that I've reduced this asset by $400 for the office supplies that I've used. So when I do my adjusting entry on December 31st, I need to credit the asset office supplies for $400. And that's my balance sheet account. So my debit would have to be to an income statement account, which would be supplies expense. So I'm going to debit supplies expense for 400 and I'm going to credit office supplies for 400. Remember, debits are listed first, credits are listed second, and credits are indented. So now when I look at my T accounts, notice that my office supplies T account is correct at $100 and I've correctly listed supplies expense to show how much supplies I have actually used, how much assets I actually used during this period. Now, depreciation is an interesting topic and it's one that people don't really understand. We hear people use the word depreciation and we think it means one thing, but this is one of those cases where in accounting we mean something very different than what people think it means. So most of the time when we hear people talk about depreciation, they're talking about it in with respect to a car or something like that, and they're referring to how much the car has declined in fair market value. So it's like, oh, I bought this car last year for $20,000, but now it's only going to sell for 8,000. It had 12,000 of depreciation. That is not what depreciation means, at least not in an accounting standpoint. So let's go through and talk about what depreciation actually means. Now, we're going to come back and spend most of chapter 9 digging into depreciation in much greater detail. So this is just kind of a hit the high spots of what depreciation is at this point. So first of all, we depreciate assets, but not all assets. We depreciate a specific category of assets called property, plant, and equipment. You'll also hear these called plant assets or even capital assets, and that's capital with an AL, not OL like Austin and Washington, D.C. What makes this category of assets, those characteristics, is a couple of things. Number one, they have a long life. Specifically, we're going to be using them for more than a year. If it's something that we're going to use for a year or less, then it doesn't get depreciated. Second, they are tangible, meaning they have a physical substance to them. You can touch them. Again, that will become more important in chapter 9. Third, they are used in the business. This isn't an asset that we purchased as an investment. This isn't something like that. This is an asset that we are actively using in our business. And the fourth characteristic, which isn't listed in this definition but is kind of common practice, is that they are something that is relatively expensive. Okay, so I usually use the example if we're in a classroom setting of the trash can back there at the back of the classroom. We're probably going to use that for more than a year. It's definitely tangible. I can touch it. It is being used in the business, but it probably costs $30 and we're not going to depreciate it. We're just going to call it an office expense or a supplies expense, and we'll expense it when we do that office supplies adjusting entry. So typically these are things that are very expensive. So common examples: buildings, equipment, furniture, fixtures, computers, land, things like that. So all plant assets except for land get depreciated. Land does not get depreciated. We'll talk about that more in chapter 9. But all other plant assets get depreciated. Now, here's what depreciation is not. Depreciation is not a valuation process. Depreciation is not in any way, shape, or form attempting to mimic or estimate or state what the actual fair market value or resale value of this asset is. Depreciation is an allocation process. We are taking the cost of the asset and allocating that cost over the asset's useful life. Okay, we're going to walk through an example in just a minute. So we record depreciation similar to the way we record prepaid expenses. I bought the building or the car or the equipment now. I'm going to use it over several years. As I use it, I'm going to depreciate or record part of it as an expense to show that I've used up some of this asset's life. When we purchase an asset, and when we start to depreciate an asset, we know how much we paid for that asset. We know what the cost is. We are going to estimate what is called the useful life. The useful life is how long we intend to use the asset. So let's say that I bought a car and I said I'm going to drive this car for 5 years. That's my estimate. I'm also going to estimate what I think I can get for the asset at the end of the useful life, when I'm through using it. So let's say I bought a car and I said I'm going to drive this car for 5 years and then I'm going to trade it in or sell it, and I think I'm going to get $5,000 for it. That $5,000 is called the residual value. You'll also hear it called salvage value, trade-in value, resale value. All of those terms are used interchangeably. Okay, it is an estimate. Your residual value is an estimate. Your useful life is an estimate. So here we're told on December 2nd, we purchased some furniture for $18,000 cash. We expect to use the furniture for 5 years, and we're estimating that we'll have zero residual value, meaning at the end of 5 years, we don't think we're going to sell it. We're just going to donate it or give it away or whatever. So let's do the journal entry on December 2nd when we buy the furniture. Now remember, furniture is an asset. Assets have a normal debit balance. So since I have more furniture than I did before, I want to debit the furniture account. Since I paid cash for it, cash is an asset, has a normal debit balance. So to decrease it, because I have less cash now than I did before, I want to credit cash. So I've debited furniture and I've credited cash for $18,000. Now remember, for all assets are recorded at their historical cost. So when I put this in my books, I have to leave the furniture at $18,000. So here I have my furniture T account that I have debited for $18,000. Now, we're going to talk about in this chapter what's called straight line depreciation. Straight line is not the only method of calculating depreciation. We'll talk about several more when we get to chapter 9, but for right now, we're just going to look at straight line depreciation. Straight line is the easiest to calculate, and it's also the most commonly used. So straight line says we're going to take the same amount of depreciation every year. So our numerator would be what's called cost minus the residual value. This term is also called, this numerator, this cost minus residual value, is also called the depreciable cost. Depreciable cost. And again, we'll talk about that more in chapter 9. And then we divide it by the useful life, which in our case was 5 years. Right? So the cost of the furniture is $18,000, the residual value is 0, and the useful life was 5 years. Now, we haven't owned this furniture a whole year. We just bought it at the beginning of December. Here it's the end of December, so I'm not going to take a whole year's worth of depreciation. I've only owned it 1 month. So 5 years is the same thing as 60 months. So I could say cost minus residual value divided by the useful life in months. 5 years times 12 months is 60 months, and calculate a monthly depreciation if I wanted to. So since we think we're going to use it for 5 years, you can do it one of two ways. I can say 18,000 minus 0 divided by 5, which gives me 3,600 per year. Divide that by 12 months means $300 per month. An alternative way of calculating that is, as I was saying before, we could say 18,000 minus 0 divided by 60 months, and we would still get $300 per month. So what this means is we've bought this furniture, we've used it for 1 month, we're estimating that we have used up $300 of this asset's useful life. Anytime we use up an asset, that is an expense. So I need to do a journal entry to debit depreciation expense to show that I've used up $300 of this asset. So here I just went ahead and give you the entry. Notice that we are debiting depreciation expense, but let's look at our credit. Okay. So it would make sense to say, oh, I'm going to credit the furniture account because I've used up the furniture, so I'm going to reduce the asset. Except that the historical cost concept says all assets have to be recorded at their historical cost. So the furniture has to be recorded at $18,000 because that's what I paid for it. I'm not allowed to mess with that account. I'm not allowed to adjust that account. As long as I own this furniture, it has to be on my books at $18,000. So instead of crediting the asset, I'm going to credit a new account. This account is called accumulated depreciation. And accumulated depreciation is what we call a contra asset. contra asset. Now we're going to have lots of contra accounts as we go throughout the semester, but contra means opposite or offsetting. So what we're going to see is basically accumulated depreciation is a partner to the furniture account. These two accounts are partnered together. So on my balance sheet, I'm going to show furniture 18,000. And then right underneath it, I'm going to show accumulated depreciation of 300. And I'm going to say, look, I paid 18,000 for this furniture, but I've used up $300 of it. So I'm constantly showing how much of it I've actually used. So contra asset appears on the balance sheet. Now, since contra means opposite, the contra asset account has a normal credit balance. So accumulated depreciation has a normal credit balance. So I've debited depreciation expense and I've credited accumulated depreciation. So again, accumulated depreciation is this account that's going to hold all of the depreciation. Remember, accountants are not real creative. So accumulated depreciation is where all the depreciation accumulates. So every year as I depreciate this asset, accumulated depreciation is going to get larger and larger and larger. So again, the two characteristics, number one, it is paired with its asset account. So accumulated depreciation is paired with the furniture account. They're partners. And on the balance sheet, it will be listed immediately after the asset. Okay, we're going to list furniture and then accumulated depreciation. And the normal balance of a contra account is always the opposite. So a contra asset will have a normal credit balance. Since assets have a normal debit balance, contra assets will have a normal credit balance. So again, furniture has a normal debit balance. The contra account is going to have a normal credit balance. Now on my balance sheet, remember we said we're going to list the asset and then immediately underneath it, we're going to show accumulated depreciation and we're subtract it. Notice that it's in parentheses because we are subtracting it. So that gives us what we call the book value, or you'll sometimes hear it called the net book value. Now, this book value, the 17,700, is not what we think we can sell the furniture for. We are not even attempting to estimate that. What we are saying is that this furniture has $17,700 of life left in it. Okay, we're not saying that that's what we can sell it for. We are not even taking that into consideration. So deferred revenues we talked about earlier in chapter 2, except we called them unearned revenue. Deferred revenue and unearned revenue are terms that are used interchangeably. I tend to use unearned revenue when I'm talking about it, but deferred revenue is a term that you will hear. Remember, this is when a customer pays us money before we've done any work. So if you remember, the customer paid us money, we recorded that, we took their money, and then we recorded a liability that we called unearned revenue to say, hey, I owe them work. I took their money, now I owe them work. So if you remember back in chapter 2, on December 21st, we had a law firm that paid us $600 in advance for us to provide online training services for them over the next 30 days. So we took their money, we debited cash, and then we credited that unearned revenue account. And remember, unearned revenue is a liability. And I encourage you, you might want to write liability or put an L beside it in your notes because it's one of the few liabilities we have that does not end in the word payable. And remember, liabilities have a normal credit balance. So we are increasing this unearned revenue account to show that, hey, we owe them $600 worth of work. Okay. Now, here it is, December 31st. Remember, we had a 30-day contract with them. We've been working over the last 10 days. So we owed them $600 worth of work, or 30 days of work, and now we have earned 10 of the 30 days, or we have earned 1/3 of the work. So if I were to look at my unearned revenue T account and show that it has a credit balance of 600, well, that's not entirely correct because I've done some of the work. I don't owe them 30 days of work anymore. I only owe them 20 days of work. So I want to somehow reduce that liability to show, hey, I've done some of the work. So if liabilities have a normal credit balance, then to reduce it, I want to debit it. So I want to debit the unearned revenue account to show that I've done a third of the work or 10 of the 30 days. And then I remember liabilities appear on the balance sheet, so my credit's going to have to be to an income statement account, revenue or expense. Now, since revenues are always, always, always credited, and I've earned the work, so now I get to call it revenue, I'm going to then credit service revenue. So I've debited unearned revenue to reduce the liability, and I've credited service revenue to say, hey, I've done this work. I get to call it revenue. I get credit for it, literally get credit it by crediting my service revenue account. That's a little bit of accounting humor for you because I've now done the work. So when I post this to my T accounts, notice my unearned revenue account now has a balance of 400, which says, hey, I just owe them 20 days of work now. And service revenue now correctly shows all the work that I've done. This is all the work that I've done since November 1st.